Investing can seem daunting, especially if you're just starting with $100. But remember, every oak tree starts as a tiny acorn. That $100 is your seed. It's the first step towards building wealth. You might be thinking, $100 won't get me far. And you'd be right if you spend it. But if you invest it wisely, it can grow into something much bigger. It's about starting the journey. Many people think they need a lot of money to start investing. That's simply not true. With just $100, you can begin your investment journey. There are options out there for every budget. The key is to start small and stay consistent. Don't underestimate the power of compound growth. Even small contributions made regularly can add up over time. Think of it like planting a tree. It takes time to grow into something strong and tall. So, take that first step. Plant your $100 seed. Water it with smart decisions. Watch it grow into a mighty financial oak. Before you start chasing big returns, you need a safety net. Life happens. Unexpected expenses pop up. A car repair, a medical bill, a leaky roof. Without an emergency fund, these unexpected costs can derail your financial progress. You might be forced to go into debt, wiping out your investment gains. A high-interest savings account is the perfect place for your emergency fund. Aim to save at least 3 to 6 months' worth of living expenses. This might seem like a lot, but remember, it's your financial safety net. It's there to catch you if you fall. Look for banks that offer competitive interest rates on their savings accounts. Every little bit helps. Even though interest rates might seem low, they still beat stuffing cash under your mattress. With your emergency fund in place, you can breathe easier. You'll be financially prepared for life's unexpected curveballs, and you can focus on growing your wealth through investments, knowing you have a safety net to fall back on. Gold. The very word evokes images of wealth and stability. For centuries, gold has been a safe haven asset. It's a hedge against inflation, a store of value that has stood the test of time. Unlike paper currency, which can be printed endlessly, gold is finite. Its scarcity contributes to its enduring value. There are several ways to invest in gold. You can buy physical gold, like coins or bars. This gives you tangible ownership, but it comes with storage costs and security concerns. Or you can invest in gold ETFs, which are exchange-traded funds that track the price of gold. These offer convenience and liquidity. Gold is not a get-rich-quick scheme. It's a long-term investment. It's a way to preserve your wealth, especially during times of economic uncertainty. When inflation rears its ugly head, gold shines even brighter. It's a valuable addition to any diversified portfolio. Investing in the stock market can seem intimidating, but there's a simple, effective way to participate in index funds. An index fund is like a basket of stocks that tracks a specific market index, like the S&P 500. When you invest in an index fund, you're essentially buying a small piece of all the companies in that index. Index funds offer several advantages. They're diversified, which reduces risk. They have low fees, which means more of your money stays invested. And they're easy to understand. You don't need to be a stock market expert to invest in index funds. Even Warren Buffett, the legendary investor, is a fan of index funds. He once famously bet a group of hedge fund managers that a simple S&P 500 index fund would outperform their actively managed funds over a 10-year period. Guess who won? That's right, the index fund. Investing in index funds is like riding the market wave. You're not trying to time the market or pick individual winners. You're simply going along for the ride, capturing the overall market return. It's a smart, low-cost way to grow your wealth over the long term. Section 5. RE8s, Investing in Real Estate, Brick by Brick. Real estate has always been a popular investment. It's a tangible asset. It can generate rental income, and it tends to appreciate in value over time. But not everyone has the capital or desire to buy properties directly. That's where REITs come in. REITs, or Real Estate Investment Trusts, are companies that own and operate income-producing real estate. They invest in various properties, such as office buildings, shopping malls, apartments, and hotels. When you invest in a REIT, you're essentially buying a share of these properties. One of the main advantages of REITs is their high dividend payouts. By law, REITs are required to distribute at least 90% of their taxable income to shareholders in the form of dividends. This makes REITs an attractive option for income-seeking investors. Another benefit of REITs is their liquidity. Unlike physical real estate, which can be illiquid and difficult to sell, REITs are traded on stock exchanges. This means you can buy and sell them easily, just like stocks. If you're looking for a way to add real estate exposure to your portfolio without the hassles of direct ownership, REITs are worth considering. Section 6. Flipping for profit, turning trash into treasure. One man's trash is another man's treasure. That's the basic premise behind flipping. It's the art of buying something at a low price and selling it for a profit. It's a side hustle that can be both profitable and fun, and you don't need a lot of money to get started. The key to successful flipping is finding undervalued items. This could be anything from pre-owned electronics to vintage clothing to collectibles. Once you've found an item, you need to assess its condition, research its market value, and determine a fair price to buy it for. Then, it's time to list your item for sale. Online marketplaces like eBay and Facebook Marketplace have made it easier than ever to reach a wide audience. Take clear photos, write a compelling description, and set a competitive price. With a little effort, you can turn your trash into someone else's treasure and make a profit in the process. Section 7. Stocks and crypto. Navigating the high seas of investing. Individual stocks and cryptocurrencies are like the high seas of investing. They offer the potential for high rewards, but they also come with significant risks. It's important to approach these investments with caution, especially if you're a beginner. Investing in individual stocks requires research and due diligence. You need to understand the company's business model, its financial health, and its competitive landscape. Timing the market is crucial, and even experienced investors can get it wrong. Cryptocurrencies are digital or virtual currencies that use cryptography for security. They've gained popularity in recent years, with Bitcoin leading the charge. However, the crypto market is highly volatile and unpredictable. Prices can fluctuate wildly, and there's always the risk of fraud and scams. Before investing in stocks or crypto, take the time to educate yourself. Understand the risks involved. Don't invest more than you can afford to lose. And if it sounds too good to be true, it probably is. Section 8. Diversification. Don't put all your eggs in one basket. You've probably heard the saying, don't put all your eggs in one basket. This age-old wisdom applies perfectly to investing. Diversification is the key to managing risk and maximizing returns. When you diversify your portfolio, you're spreading your investments across different asset classes, such as stocks, bonds, real estate, and commodities. You're also diversifying within each asset class. For example, instead of investing in just one or two stocks, you might invest in a broad market index fund. The goal of diversification is to reduce the impact of any one investment on your overall portfolio. If one investment performs poorly, others can help offset those losses. It's like having a safety net for your investments. Diversification is not about avoiding risk altogether. It's about managing risk effectively. By spreading your investments, you're reducing the likelihood of large losses and increasing the potential for long-term growth. Section 9. The long game compounding and tax advantages. Investing is a marathon, not a sprint. It's about playing the long game, making smart decisions consistently, and letting the power of compounding work its magic. Compounding is the process of earning interest on your interest. It's like a snowball effect. As your investments grow, your earnings also grow, compounding over time. The earlier you start investing, the more time your money has to compound. Even small contributions made regularly can add up to a significant amount over the long term. It's never too early to start investing. To maximize your returns, take advantage of tax-advantaged accounts, such as Roth IRAs or ISAs. These accounts allow your investments to grow tax-free, which means more money stays in your pocket. Investing is a journey, not a destination. It's about making smart decisions today to secure your financial future. By following these tips, you can start building wealth, no matter how much money you have to begin with.